Now we're going to look at dividend stripping, paragraph 19 of the 8th schedule. Now, like I always say to people, have you ever seen a naked dividend? It's not a sexy sight at all. So, as long the sections might sound very sexy to you, but it's probably not as much as you think. Okay, so what is a dividend? What is dividend stripping? Now, I'm going to just use this as a simple example. Guys, just bear with me for the principle here. Maybe technically some of the amounts here might be a little bit strange, but just bear with me for now. Let's look at a statement of financial position of a company. So this is a dormant company. This company, under its assets section, only has a cash balance of 100,000 rands. And then under its equity section, it has share capital, and I'm just going to call this contributed tax capital. Let's say that's 1,000. And then it has retained earnings of 99,000 rands. Okay. Now, this company only has cash. What is the value of this company? So it's not a company, it's not special, it doesn't have any special licenses or anything strange like that. What is the value of this company if you just look at it like this? The value of this company is 100,000 rands. That's how much you would pay for it, wouldn't you? There's 100,000 rands in the bank. I wouldn't pay more for it because then I'm losing. And if I could pay less, absolutely, I'd take it. But realistically, if the company has only 100,000 rands in the bank, that's what the value of it is. Now, I own this company. So now I want you to see what happens. So I go to myself and I say, all right, Roland, maybe let's say it's not me. Okay, I'm actually going to use this as a better example. Let's say the shareholder is a South African company. Another South African company holds the shares in this. Now, why am I saying this? Because if one company pays a dividend to another company, there's no dividend tax. This is the perfect example to illustrate what dividend stripping does. So, what this shareholder does, who is the owner of this company, the shareholder says, all right, company, pay me a dividend of 99,000 rands, so equal to your retained earnings. So this company decreases its cash. There's now 1,000 rands left. Well, in fact, let me actually do it as follows. You say the dividend, pay me out the full 100,000 rands as a dividend. Okay, now let's say I'm not paying my contributed tax capital back. Remember, the directors decide that. I'm just saying strip out the cash reserves. So I pay a dividend to that company. There's no dividends tax. Why? Because the company is the shareholder is a South African company, and Section 64F says there's no dividends tax. So now basically we have no cash. So this company is now worth nothing, and we have shares of 1,000 rands. Right. So now I decide, this shareholder decides, after we've done this, what I'm going to do is I'm now going to sell my shares for 1 rand. The base cost of those shares is 1,000 rands. That's how much is spent. So this person makes a capital loss of 999. So here's my CGT column. So they want to put this capital loss in there. Now, tell me, do you think SARS is happy with this? So what happens? First up, you take the full value of the company, you pay it out, there's no dividends tax. So SARS doesn't get anything there. Then you sell these shares and you make a capital loss. And the capital loss is not great for SARS because it's going to decrease your future capital gains. So what I want you to see and understand, what happened here is you used the dividend to strip the value out of this company. This company was worth 100,000 rands. You used a dividend of 100,000 rands to make this company worth nothing. So you basically sell it for 1 rand and you make a loss. SARS does not like this. SARS says, if you calculate a capital loss here on the disposal of shares, and you had a dividend recently, then we're not going to necessarily allow you to claim that loss. And that's what paragraph 19 tries to tell us about. So let's take a look at it. So I want you to understand, when do we look at paragraph 19? It does not only apply to liquidations. It applies to any situation where you sell shares and it results in a capital loss. So where you say proceeds less base cost and it creates a capital loss, any situation of that with shares, you have to consider this. We just see this section more often applied to liquidations, and it has a special rule for liquidations we'll see. What it means is that loss then, which you want to put into your CGT column, you will not be allowed to put it in there. Okay, so two important definitions in paragraph 19 that you need to be aware of. The term exempt dividend and the term extraordinary exempt dividend. These are two definitions in paragraph 19. The most important one for you is the first one, because that's the one that links to liquidations, which you see most often. Okay, but let me explain to you what this is. We all know that dividends are exempt. So when you receive a dividend of 100,000 Rand, you put in your Rands column, and the amount is then fully exempt. That is not what they're referring to here. An exempt dividend here is a dividend which is 100% exempt under section 10(1)(k), so like what we did here, see that's 100% exempt, or section 10(b)(2)(a), this is a foreign dividend where you own 10% or more of the shares, right? If that was a foreign dividend, in that case, you would do the same thing as you did here. It would be fully exempt, okay? And it would be section 10(b) here. It would be fully exempt. And this is important. This is the one which students mess up. There must be no dividends tax paid. When is there no dividends tax paid? For example, if one company pays to another. So what does SARS say? It's this exact example that I just used here. The dividend of 100,000 Rands is 100% exempt, and there's no dividends tax. So how much money does SARS make out of that transaction? Nothing. So if SARS makes nothing, then they don't want to allow you to claim a capital loss. So for now, an exempt dividend is a dividend which is 100% exempt from income tax and 100% exempt from dividends tax. So 100% exempt for income tax and dividends tax. Okay, that's an exempt dividend. An extraordinary exempt dividend is a dividend which is calculated as the exempt dividend, so this amount, less 15% of the proceeds on the sale of that share. Okay, so if you sold a share for 100,000 Rands and the dividend is 20,000 Rands, you'll say dividend less 15% times 100,000 Rands. And that gives you 15,000 Rands. There we go. That 5,000 that remains, that is the extraordinary exempt dividend. In other words, it's a dividend which is more than 15% of this that it was sold for. Yes, that it was sold for. Okay, now why is it important? Here we go. Paragraph 19 is split into two parts, 19(1)(a), 19(1)(b). 19(1)(b) applies to liquidations. 19(1)(a) applies to liquidations. 19(1)(b) applies to any situation where 19(1)(a) is not applicable. So, example, sale of shares. This is the most common one. Paragraph 19(1)(b) is if you sell shares. Paragraph 19(1)(a) is if it's a liquidation. Now, for paragraph 19(1)(a), you will use the exempt dividend calculation or amount, that amount. And for paragraph 19(1)(b), you will use the extraordinary exempt dividends amount. Okay, so let me explain. 19(1)(a), liquidation one. Where a person disposes of a share as a result of the acquisition of that share as part of a liquidation, right? That person must disregard so much of any capital loss that does not exceed any exempt dividends. See, there's that term, exempt dividends, which has been received within a period of 18 months prior to the disposal. Okay, so what they say here is they say, you're now going to do the calculation. Proceeds, let's say it's 100,000 rands. Base cost, let's make it 250,000 rands. So you've had a capital loss of 150,000 rands. Here's my CGT column. Usually I want to move it in here and I want to put it in there. Now we say, no, can't do that yet. What you need to do is you need to look in the last 18 months, so including today and the previous 18 months, did I receive any exempt dividend? Now remember, it's 100% exempt from income tax, and it is 100% exempt from dividends tax. Must be both. So this is the question you have to ask yourself. Was it 100% exempt for dividends tax? That will usually be the case. And was it 100% exempt for income tax? And was it 100% exempt for dividends tax? That is the big question. Here you would usually look at who is the shareholder. If the shareholder is a natural person, then there was dividends tax, so it's not exempt. But if it's a company, it would be. So just bear with me for now. This capital loss of 150,000 rands, you will then compare it to your exempt dividend. And only if this amount, whatever that amount is, which is more than the exempt dividends, will be allowed. So let's say your exempt dividend was 100,000 rands that you received, then your capital loss is 50,000, and that amount can be claimed. Let's say your exempt dividend was 200,000 rands, so the loss is less than the exempt dividend, then there's no amount that will be allowed to be claimed. That's basically how it works. Okay, so only the amount which exceeds the exempt dividend will be allowed. Paragraph 19.1b, this is a section that applies to all other situations, most often if you are selling or donating shares. Here we will do the same thing. You'll say proceeds, let's say 100,000. Base cost, 250,000. Gives 150,000 rands loss. You will then compare that to the extraordinary exempt dividends, which they say is the amount of the aggregate of any exempt dividends within a period of 18 months which exceeds 15% of the proceeds. Now my proceeds here is 100,000 rand. So if my exempt dividend, remember exempt from tax, income tax and dividends tax, if my exempt dividend was 300,000 rands, from that I need to deduct 15% of my proceeds, which is 100,000 times 15. Right, leaves me with 285. That 285, right, my loss does not exceed that amount, so nothing will be allowed. Okay, so you get the idea? If my exempt dividend was 100,000 rands, I would deduct the 15,000 from it, left with 85,000. 85,000, the 150,000 minus 85,000, 65,000. So 65,000 rands will then be allowed as a loss that I can claim. So you can only claim a capital loss if it is more than the exempt dividend, or in this case the extraordinary exempt dividend. So again, when do we apply paragraph 19.1a? When there's a liquidation. When do we apply paragraph 91b? When there's any other disposal that is not a liquidation. Okay, and that is basically it. So guys, this looks a little bit complicated. You'll see when you look at your examples on this, it is very, very simple. I don't want you to overstress this. 1 or 2 marks max.